All right, let's pull back the curtain on a really fascinating way to invest. We're going to talk about a product called GVIP. It's an ETF that basically tries to bottle up the best ideas from some of the world's top hedge funds. So let's dive right in and see what this is all about. You know, it's a question I think almost every investor is asked at some point. What if you could just get a peek inside the portfolios of the so-called smart money? What are the stocks they're betting on the most? Well, that's exactly the idea we're going to unpack today.
So here's our roadmap. First, we'll talk about what these top ideas really are. Then, we'll get into the secret sauce that makes this possible, a document called the 13F filing. After that, we'll see exactly how GVIP gets built, check out how it's performed over the years, and finally, and this is super important, we'll cover the strategy and the risks you have to be aware of.
Okay, so first things first, how does a regular person like you or me get a look at what these massive, sophisticated hedge fund managers are doing? That's the exact puzzle this whole strategy is designed to solve.
The concept is actually pretty simple, and that's what makes it so powerful. Instead of trying to invest in a hedge fund, which, let's be honest, is practically impossible for most of us, this ETF just buys the stocks that are the most popular among them. It's like you're crowdsourcing the conviction of all these top-tier managers into one portfolio. And that's exactly where the name comes from. The VIP in GVIP stands for very important positions. And that's key. These aren't just some random stocks they own. These are the ones that show up in their top 10 holdings. These are the ideas where they've put the most capital, signaling their absolute highest conviction that these stocks are going to go.
Okay, but you might be thinking, how on earth do we know what their top positions are? Are they just telling us? Well, not exactly. It's not magic, it's data. And that data comes from a very specific regulatory filing that is the secret ingredient behind this whole thing.
And here it is. It's called a 13F filing. Basically, the law says that any big-time investment manager, we're talking over 100 million in assets, has to report their U.S. stock holdings to the government every quarter. And because they report it to the government, it becomes public information. It's an absolute treasure trove of data.
So, to boil it down, it's a required report for the big players, and it shows us what stocks they're betting on to go up, their long positions. Now, it doesn't show us everything, like what they're shorting, but it gives us this incredible snapshot of what they're really bullish on. This filing is the raw material, the building block, for the GVIP index.
So we have all this data from these filings. How does that get turned into a focused 50-stock portfolio you can actually buy? Let's walk through how it's built.
The process is actually pretty methodical. First, they screen for over 650 hedge funds that focus on fundamental analysis. Then they use tech to scan every single one of their 13F filings to pull out all the holdings. From there, they zoom in on just the top 10 biggest positions for each fund. And finally, they just count them up. The 50 stocks that appear most often across all those top 10 lists are the ones that make it into the index, and each one gets an equal slice of the pie.
And there you have it. That process creates the GS Hedge Fund VIP Index. And since those 13Fs come out every quarter, the index gets a refresh 4 times a year. This keeps it up to date with the shifting ideas of these top managers.
Okay, so we know the recipe and how it's made. But the million-dollar question is, how does it actually perform? What does this portfolio look like in the real world?
What's so cool is seeing how the portfolio morphs over time. It's like a living thing that follows the big market stories. You can see here, before the 2008 crash, it was packed with financial stocks. Makes sense, right? But then, in the years after, you see this massive shift into tech and consumer stocks. It just follows where the smart money sees the big opportunities. It's not static at all. It's designed to be dynamic.
Now, when we look at the long-term performance, you see a real story of peaks and valleys. There have been these incredible stretches where GVIP just left the S&P 500 in the dust. But there have also been some pretty significant downturns where it lagged behind. And that tells you something really important. This is a higher octane, higher risk strategy. This is not your plain vanilla index fund.
And this table, man, it just makes that volatility crystal clear. In those big risk-on years like 2020 or 2023, this index absolutely crushed the S&P 500. We're talking double the returns in some cases. But then look at a tougher year like 2018. It actually lost more than the market. That's the trade-off. This is a concentrated bet that can pay off big when risk-taking is in favor, but it can also amplify your losses when things get choppy.
And that brings us to what might be the most important part of this whole discussion. How should an investor actually think about using a tool like this? And maybe even more critically, what are the risks you absolutely need to have on your radar?
So you could use this in a few ways. But really, the smartest and most effective way
is as a tactical tool. This is not a set-it-and-forget-it kind of investment. The key is to pair it with your own view of the big picture, a macro overlay. You have to understand where we are in the business cycle. When the economy is roaring and it's a good time to take on risk, a higher beta strategy like this can be a rocket ship for your portfolio. But you have to be just as willing to dial that exposure way down when the environment gets shaky and it's time to play defense. It's all about knowing when to step on the gas.
And these risks, they really drive that point home. Forget the standard risks for a second and look at that last one, index data lag. Think about it. The 13F data can be up to 45 days old before it even gets filed. By the time the index rebalances, the managers you're trying to copy might have already sold that stock. This is huge. It means the data is always looking in the rearview mirror. It just hammers home the idea that you can't follow blindly. You have to use your forward-looking view to decide when this kind of offensive strategy makes sense.
So we land on this question. GVIP gives you this incredible, unique window into the high-conviction ideas of some of the best in the business. It's a powerful tool for sure, but as we've seen, it's a sharp tool. It comes with real risks, and it absolutely demands a tactical mindset. Because ultimately, the smartest move isn't just following the smart money, it's knowing when and why you're following them in the first place.